Most founders approach raising $5 million the same way they raised their seed round, and that's exactly why they fail. At $5 million and above, you're no longer pitching angels who invest on vision. You're entering institutional territory where allocators demand things like proof of execution, unit economics that actually work, and a syndicate structure that protects their downside. So if you show up with a pitch deck and hope, you're going to get ghosted by every serious fund you approach. Now, the companies that successfully raise 5 to 50 or 100 million don't just have better ideas, they have better infrastructure, the actual foundation. They've built the systems institutional investors absolutely require before they even take the first meeting. And if you try to wing it, you'll burn through your network, destroy your valuation, and end up with predatory terms, if you do get funded at all, that cost you the company in the long term. You don't want to do that. Let me tell you a story about a founder we worked with. Let's call him Marcus. Marcus had built this logistics SaaS platform doing 180,000 monthly recurring revenue, growing 12% month over month. Really great, incredible business. He spent 9 months pitching VCs for a $10 million Series A. Took 147 meetings. Yes, you heard that. 147 meetings. And he got 0 term sheets. Why? Because Marcos had revenue, but he didn't have the infrastructure, the foundation. No board of advisors, no financial model that passed institutional level scrutiny, no clean cap table, no existing syndicate from his seed round that would follow on, and he was trying to raise institutional capital with a garage stage operation. That's not going to cut it. So what did we do? We restructured everything in 77 days, brought in 2 operators with exits as his advisors, built an institutional grade financial model with cohort analysis, cleaned his cap table, and got commitment letters from existing seed investors. Created a data room that answered every single question before it was even asked. Targeted 22 funds that had proven thesis in this exact category. He closed 12 million at a 65 million post-money valuation in 11 weeks. Same founder, same company, different infrastructure. And that's what this video is about. The actual institutional level playbook that works at scale. So if you're sitting on a business currently doing 100,000 plus monthly recurring revenue, or you've got massive traction in a hard to monetize space, or you're simply at the stage where you know the next 5 to 20 million will determine if you build a real company or just another startup that fizzles, this is your roadmap. Number 1, pre-flight. Build institutional infrastructure before you raise. Hear me, before you raise. And here's the uncomfortable truth. Institutional investors, they don't invest in potential. Shocking, I know. They invest in proof systems. Before you send a single email, you need 3 things. First, the authority stack. Board of advisors with relevant exits or sector credibility in your sector, at least 1 institutional grade financial hire or fractional CFO, brand signals, press awards, partnerships that position you as a category player. And now why this matters. Investors invest in teams that look fundable. If you show up solo with a pitch deck, you look like you're a risk. If you show up with a former VP from Oracle on your board and a CFO who has scaled 2 exits, you look like a bet they can't afford to miss. So second, the financial model that passes diligence. This isn't your hockey stick projection you made in Google Sheets. You need unit economics broken down to customer acquisition cost, lifetime value, payback period, and cohort retention. A 3-statement model. P&L, balance sheet, cash flow, all this ties out perfectly. Now, scenario planning, base case, upside case, and conservative case. We say this all the time. They will sniff through your phony MBA projections, so you want to give them a 3. Definitely a use of funds breakdown that shows exactly, and I mean exactly, how $5 million becomes $25 million in enterprise value. So if your model doesn't survive a 24-year-old that just graduated from Brown University with his MBA, doesn't survive his initial pass as a junior associate, you're not getting to the partner meeting. Third, the data room that removes friction. Institutional investors will ask for 40 to 60 documents during diligence. If you scramble to produce them, you look unready. Build your data room now is the point. Cap table with a clean breakdown and no weird notes, no funding to your uncle and your next door neighbor. All contracts, customer, vendor, employment, financial statements for the past 24 months, customer cohort data and churn analysis, product roadmap and technical documentation for them, legal structure and any IP registrations is a big one you want in there. You want investors saying things like, this is the most organized data room we've seen. You do that and you win. Now, number 2, the the targeting system. Stop pitching the wrong funds. Most founders waste 6, 9, sometimes even 12 months pitching funds that will never write them a check. So here's how to fix that. First, match your stage to their check size. Crazy, I know. If you're raising $5 million and a fund writes $15 to $50 million checks, you're too small. You're targeting the wrong people. If a fund writes $500,000 to $2 million checks, you're too big. So go to Crunchbase, go to PitchBook, filter by check size, 3 to 10 million. Investor stage, Series A, growth equity, sector focus, your category, geography, funds that invest in your region. You should have 40 to 60 funds on your list, not 300. Remember, this is not a spray and pray model. Now, second, look for proven thesis fit. Don't pitch funds that might be interested. Pitch funds that already have deployed capital in your space in the last 18 months, longest. Go to their portfolio page. Look at their last 10 investments. Do your research. You're asking for real institutional money. You got to do your homework. If 3 of them are in your category, they have a thesis. If 0 are in your category, they don't care how good your business is. You're off thesis. Now, third, build a syndicate strategy. No single fund is going to write you a $10 million check unless you're Stripe. You need a lead and a syndicate. Target 1 to 2 lead funds writing 3 to 5 million. 3 to 5 syndicate participants writing 500,000 to 1.5 million each. 2 to 3 strategic angels or family offices writing 250 to 500,000. Your pitch to the lead is something like, we're raising 8 million. I have 3 million committed from strategic angels and existing investors. I need a $4 million lead and I'll fill the rest with syndicate. How does that sound? Now that's a fundable structure. I'm raising 10 million and I have no commitments is not a fundable structure. Well, number 3, the first meeting, how to not get ghosted by the right investors. So great, you've got the meeting. Now what? What do you do? First, lead with traction, not vision. We see this every day. Institutional investors have heard 1,000 visions already this quarter. They fund momentum and you're opening with, we're a blank category company doing X in annual recurring revenue, growing X% month over month with X% net retention. We've proven the model works in this geographic location or segment, and we're raising X amount to scale into adjacent market or the next stage. Then shut up, stop talking. Let them ask the first question. Second, answer the 3 questions they're already asking in their head. Every institutional investor is filtering you through 3 lenses. Number 1, can this be big? And what is that? That's TAM, market dynamics, winner take most potential. Number 2, can you build it? The team, that's team, execution history, operational rigor. And number 3, will I make money? That's unit economics, path to profitability, exit multiples in your category, etc. If your pitch doesn't answer all 3 in the first 15 minutes, you're getting ghosted. Third, create FOMO without being cringe. Let's be honest. Don't say we have a lot of interest or this is revolutionary. That's what everybody says. Say, we're talking to Fund A and Fund B, and we're hoping to have term sheets in hand by X date. If this is interesting, I'd love to move quickly so you're part of the process. You see the difference? You're not begging them, you're qualifying them. Remember, you're looking for a partner, and this is a long-term partner, so you want to do this right. You don't want just any old check to come in. Now, number 4, the close. How to get from interest to term sheet. Interest, let's be honest, it means nothing. Term sheets mean absolutely everything. First, run a disciplined process. Now, what does that mean? Once you have one serious fund, set a deadline, 4 to 6 weeks from first meeting to term sheet. Update all active funds weekly, saying things like, we're in diligent with Fund X, expecting a term sheet by X date. Wanted to keep you in the loop. Get multiple term sheets so you have leverage. You don't want to lose that leverage. Never negotiate with one term sheet. You will get destroyed on terms, every case scenario. Now, second, negotiate like you're going to work with them for 10 years because you are. The 3 things that matter most, okay? Valuation, obvious, but not the most important. Liquidation preferences, 1x is standard. Anything above that, we consider predatory. Board composition, you want control as long as possible. Don't optimize for the highest valuation. Optimize for clean terms with a fund that can support you in the next round. Now, third, close fast. Once you have your lead term sheet, you have 10 to 15 days to fill the rest of the round. Any longer and you look like you're struggling. So move decisively, get signatures, get the money wired, then get back to building. Here's what most founders get wrong about raising $5 million and above, which is what we call institutional capital. They think it's about pitching better. Well, it's not. It's about building the infrastructure, that foundation that we always talk about. about. Targeting the right funds with precision and running a disciplined process that creates the leverage you need to close on your terms. Without this infrastructure, what are you doing? The difference between a 9 to 12 month nightmare fundraise and a complete collapse and dilution of your business and a 10-week victory lap, it's infrastructure. Now, Marcus didn't change his business, he changed his system, he changed his infrastructure, he changed his foundation, and that is what you need to do. If you want to know exactly how to build that financial model that passes institutional diligence, the one that gets you into partner meetings instead of getting ghosted, well, that is this video right here. I'll walk you through the exact template we use with clients raising $5 million to $250 million and above, line by line. So if you're serious about raising institutional capital and you don't want to waste 6, 12, 18 months getting ghosted by funds that were never going to write a check in the first place, we built a system for this, obviously. So here at IRC Partners, we work with 7 to 9 companies per quarter, raising anywhere between $5 million to $2 billion. We've got access to over 307,000 allocators worldwide, 77 investment banks that we syndicate with. We share deals, we share investors. If there's a deal out there, we know how to get it closed. So if you're doing 100,000 or more monthly recurring revenue, or you've got traction that justifies institutional capital, I'd invite you to book a call with our team. There's going to be a link in the description below, and we'll tell you within 15 minutes if you are ready and if you're not. And if you're not, we'll tell you exactly what to fix and how to fix it on that call. So let's close your next round, and I'll see you in the next video.